Good evening, everyone. Time for another silver update. Now, this is the Dow Jones Transportation Average provided by netdania.com. You can click on the link below. And you can see I've drawn a trend line here of the index starting at the March 2009 bottom. We know that was the beginning of the stimulus rally, and we're still in that rally. You can see that the overbought condition on this transportation index is actually so high now. The only other relative point would be here, is that just to correct back to the uptrend line would be a 15% correction. You can see that the Dow Jones Transportation Average has more than tripled since that bottom. So an unbelievable run in the equities. It's just insane, and we're going to see how even with a run like that, it's still not making a difference in the decay of the financial fantasies that these governments are involved in. So I want to look at what's going on in Vallejo, California. Now, if you remember, Vallejo, California had to file for bankruptcy. They did that a number of years ago, and they chose during that bankruptcy reorganization to not abandon CalPERS, to not touch CalPERS. So let's read a little bit of this, and I'm going to talk about it. Refile. 2 years after bankruptcy, California City again mired in pension debt. Vallejo struggling to pay pension costs. Pension fund, city's biggest creditor, only one not touched in bankruptcy. City's plight, a lesson to Detroit, other cities in bankruptcy, by Tim Reed. Less than 2 years ago, after exiting bankruptcy, the city of Vallejo, California is again facing a budget crisis as soaring pension costs, which were left untouched in the bankruptcy reorganization, eat up an ever-growing share of tax revenues. Vallejo's plight so soon after bankruptcy is an object lesson for 3 U.S. cities going through that process today: Detroit, Stockton, and San Bernardino, California, because it shows the importance of dealing with pension obligations as part of financial restructuring, experts say. The Vallejo experience may be particularly relevant to Stockton, which is further along in its bankruptcy case than Detroit and San Bernardino, and has signaled its intention to leave pension payments intact. All 3 current bankruptcies are considered test cases in the titanic battle between Wall Street and public pension funds over whether municipal bondholders or current and retired employees should absorb the most pain when a state or local government goes broke. Quote, any municipal bankruptcy that doesn't restructure pension obligations is going to be a failure, because pension obligations are the largest debt a city has, said Carol Deniston, a municipal bankruptcy attorney in San Francisco. A city like Vallejo can be reasonably managed, but is still going to be flooded out because it cannot be expected to keep up with its pension obligations. CalPERS, the retirement system for California public employees, said it had reached out to Vallejo to discuss concerns. Quote, employers looking to cut costs have some options that can make benefits easier to manage in the near term, some of which Vallejo has already taken. CalPERS said in a statement, we are pleased Vallejo has remained committed to delivering on the pension promises it made to its employees. So this is going to be a theme going forward, and we'll look at this on the federal level when we're done here, about promises made, and these promises are not going to be kept. CalPERS is the largest pension system in the United States and serves many California cities and counties. It has long argued that it has a much wider responsibility than managing pensions for individual cities. It says state law mandates that it is the custodian of the entire fund, and as such is unable to renegotiate pension rates that cities have agreed to with their workers. Now, Vallejo is going back into bankruptcy. That's my prediction. They'll be in bankruptcy within a year. And what's interesting is what brought this on. Let's read a little bit of this. City leaders say that growing and unexpected costs to CalPERS are putting its post-bankruptcy budget under enormous strain. The city budget shows a deficit of $5.2 million for this fiscal year. That is set to rise to $8.9 million next year unless significant cost savings can be found. When Vallejo entered bankruptcy in 2008, its annual employer payments to CalPERS were $8.82 million, or 11% of the city's general fund, according to the finance department. When it exited bankruptcy at the beginning of 2011, the payments to CalPERS were just over $11 million, or 14% of the fund. The latest budget pegs those payments at 15 or 18% of the general fund. So you can see that the payments went up from 11 million to 15 million, and it jumped from 14% to 18%. We're almost doubling now when they went in bankruptcy the first time. Now, this is the shocker. This is the thing that is really going to make you just not believe that this is happening. The increase comes largely from the recent decision by CalPERS to lower its projected investment return rate from 7.75% to 7.5%, and to change the way it calculates long-term pension maturity dates. Now think about that, people. They reduced the percentage from 7.75 to 7.5. Now, I pointed out in a number of videos that when the judge in the Madoff decision made the decision that he would claw back the funds. Now, if you remember, Madoff had been running a Ponzi scheme. He was paying out 8, 9, 10% year after year after year. And there were some early investors, and that's the way it is with a Ponzi scheme. If you remember in Social Security, I think it was Ida May, she put a total of maybe $25 into Social Security and collected $25,000. So obviously, people who are early in a Ponzi scheme make a lot of money. People who are late lose everything. But the judge in the Madoff case, when he declared that he was going to claw back some of the money from the people who had already made money from Madoff's scheme, he stated that an 8% return year after year should be evidence on its face that the thing is a Ponzi scheme. In other words, if you're an investor and someone promises you 8% year after year after year after year, then it should be known to you as a reasonable person just by that rate of return that you were involved in a Ponzi scheme. So here we are with CalPERS at 7.75 and just reducing it to 7.5, which is utterly absurd. That in this era of 0% interest rates, that CalPERS would continue to have an estimated 7.5% yearly return. It's insanity. It's financial fantasy land. But you can see that just the reduction from 7.75 to 7.5 is enough to throw Vallejo back into bankruptcy just 2 years after it entered bankruptcy the first time. Now, we're going to see the same thing in Stockton, because Stockton has also given CalPERS a pass. For government workers across California nervous about their retirement benefits, if you're a government worker in California, you should be nervous about your retirement benefits, because I'm going to tell you right now, you're not getting them. Stockton's bankruptcy plan would seem like cause for relief. The city says it will leave pensions untouched and will continue making all its required payments to CalPERS. But Stockton's plan, approved by City Council last week, is hardly the last word in the debate over whether local governments can legally cut employee pensions to reduce their financial burden. The issue is still alive in San Bernardino, which is muddling through its own bankruptcy case and whose mayor just called CalPERS costs monster. And Vallejo, which survived bankruptcy 2 years ago without tackling pension costs, but is now making noises about picking a fight. So you can see here that there is absolutely no way that these government workers are going to escape with their pensions intact. It's just not going to happen. Now, this article is from Zero Hedge. It was posted today, and this is a chart of what the U.S. government spends its money on. Now, we have a lot of debating between the right and the left. Of course, we have fake right and fake left. We have what I would call fairly real right, the Tea Party, and fairly real left, I guess, would be the Obama administration. But the debate between people that are fake conservatives like Chris Christie, who was reelected, and there's a lot of, I guess that would be the picture of a rhino. But anyway, not a fiscal conservative at all. But it's going to come to a point now that it doesn't matter which side you're on because they're simply broke. If you look at this pie chart, this is the 11 largest outlays by the federal government. Now, you can see that the two big ones here, and note that they are growing because you can see that the green is fiscal year 2013 and the blue is fiscal year 2012. You can see by far the two monster entries here are Health and Human Services, which is Medicaid and Medicare, and that's going to go up with Obamacare, and Social Security, which is going to go up because the baby boomer, that pig in the python, is just starting on the curve up. So both of these have grown big time. You can see the next ones here. Defense was cut, Treasury was cut, agriculture went up, and labor went down. VA went up a little bit, and the rest are irrelevant. So you can see here that we're talking about nearly $900 billion for Health and Human Services. We're talking about the same thing for Social Security. We'll just call that $1.8 trillion. We've got about $600 billion in defense. Now, I consider this to be welfare, but it's going to be welfare for the military-industrial complex. We know the incredible waste in that. But let's leave the military out. And so we've got $1.8 billion. The Treasury, that's going to be the interest on the debt. That's conveniently low because they pegged interest rates at zero. And this is going to show you that there's no way they can raise them. So those together, we're talking about $2.2 trillion. And so we're already above. And then, of course, you have education, and there's not the government pensions in there. So you can see from this chart that we're already above the tax revenues, and these are transfer payments. So this is tax money taken from one person and given to another. There's no question when you look at this chart and you think about the implications of interest rates rising, you can see that this Treasury portion is going to explode. Doubling is not even out of the picture, but tripling or quadrupling could very realistically happen, where we're talking about maybe 1.6 trillion in this column, and these two will be at $1 trillion each. So we're talking about nearly $4 trillion in just this stuff alone. So clearly we're approaching the end. Now, the big kicker here is that we still have this incredible bull market here. The tripling of the transportation average from roughly 2,250 to 7,000. You're talking about the types of returns that are rarely seen, probably seen only once a century in markets, or maybe twice in a century in markets. So this is going to correct. It's at least going to correct back down to this line, but it's probably going to correct all the way back down into here somewhere. At that point, the only thing holding up these unrealistic returns of 7.5 at 7.75, 8% on these investments, the only thing holding them up is going to go down. And of course, the bond market is going to go down with them. And when that happens, that means that interest rates rise. So the writing is on the wall. This whole thing is a financial fantasy. It's a financial fantasy in the cities. It's a fantasy in the counties, in the state, with the federal government. The whole thing is already bankrupt. The projections are false. It's just a bunch of lies that they're continuing until the greatest collapse in the history of the world happens. And when that happens, you're going to have physical, real assets, because all of these promises are going to evaporate at the same time. And we'll talk to you next time.